What's going on, everybody, and welcome back to your financial dose. I hope everyone's been doing well and taking advantage of the summer to the best of their abilities. And the topic for the day will be how to pay off your debts faster. So the reason why I wanted to talk about debt is because not only are all these governments around the world getting into debt, but right before the pandemic, we were actually at a peak of consumer debt. So if we look at the States, they had the highest amount of debt levels that they've had in all of history. Same thing with us Canadians. So if ever you actually lost your job during the pandemic or are trying to get by with less income, your debts will actually be accumulating if you're not able to pay them down as quickly as you originally planned. So these are a few tips to actually get in there and start managing your debt. So the first thing that you guys need to do when it comes to paying down your debt as quickly as possible is to actually quantify it. A lot of people are way too scared to actually face the music and log into their online banking account and actually figure out how much money that they owe. It could be a credit card, it could be a car loan, or it could be a line of credit that you need to pay off. But a lot of people are living in denial and they don't actually want to stop and look at the amount of debt so they can say, okay, I have $5,000 on my credit card, $2,000 on my line of credit, and another $500 left to pay off on my car. Once you're able to quantify your debt, that's when you can start planning how to pay off your debt faster. So the second tip that I want to talk about, which is also very important, is to realize whether or not you're living above your means. So if you have debt that comes from student loans, that's one thing. But if you have debt coming from credit cards that actually arose from you spending too much money or money that you did not have, well, we need to look and figure out why you spent that money. Was it necessary purchases like food, or was it something a little more frivolous like a handbag or a new pair of shoes that you didn't actually need? So if you are making, I don't know, $5,000 a month or $2,000 a month, and you're spending more than what you make, your debt levels will actually be increasing over time. This makes perfect sense. But a lot of people don't want to actually address this. They just want to try and pay off their debts as fast as possible, but they don't realize that they are overspending relative to the amount of income they're making. So again, tip number 2 is don't live above your means. Now, I'm a strong advocate of trying to spend as much on my credit card as possible because I get rewards from using that credit card. However, if you're in a situation where you have too much debt and it's out of control and you're too used to spending money on your credit card or spending money that you do not have, it would actually be a good thing to stop spending money on your credit cards. Use debit cards, use cash right away. That way, if you don't have the money, you can't buy it. Very simple. If you go with your debit card in the store and you try to swipe to buy something and you don't have the money, it'll say insufficient funds on the reader and that's it. You can't buy it. So this is a very good way of limiting overspending. Another thing is actually bringing cash to stores. Maybe now during a pandemic may not be the best time for that, but physically counting the money that you are handing over to the cashier is much harder psychologically than swiping a card and just seeing ones and zeros go away. Don't use credit cards if you have the habit of overspending. Spend on debit cards or cash only. Tip number 4. So there's something called cash advances that you can have on your credit card, and what this is, it's essentially a way for you to borrow money from it directly. So if you have a $10,000 credit card limit, and let's say you have an outstanding balance of $1,000, no problem. You need some cash for buying groceries, or you need some cash for some transaction that you actually want to use cash for and not use your credit card. Maybe they don't have a card terminal, so they can't actually take credit cards. Well, what you can do is you can go to the bank, depending on what credit card you have, and you could actually pull cash out of the card and leave with $500 in cash, and this will add another $500 to your credit card statement. However, unlike regular credit card transactions where you have a whole 3 weeks to pay for the actual transactions that you did after the month ends, so you have a 3-week grace period where you don't pay interest, when you take a cash advance, the interest is charged right away, and usually at a slightly higher rate than the original credit card interest rate. So let's say on Monday you take a cash advance for $500 and the interest rate on that cash advance is 22%. Well, right away on Monday, at the end of that day, you will be charged your whatever fraction of 22% annually for that one day that will be. So it's very hard to pay down debt if you're borrowing money from your credit card at a 22% interest rate. If this is something that you have the habit of doing, we can't go down and fully analyze your spending habits, but try to get maybe a line of credit, because the interest rate on a line of credit is going to be at least half of what it is on a credit card when you take a cash advance. Tip number 5, if ever you come into a unusually large sum of cash, so it could be either, you get birthday gifts from whoever and they give you cash, or you get a tax return. So after filing your income tax, if you paid too much income tax throughout the year, the government will refund you the amount that is due. And instead of using this money to go and buy something that you may or may not need, it would be a good idea to actually take this amount and spend it on paying down your debts. This is a great way to get ahead and jump ahead of the curve when it comes to lowering the amount of debt that you have overall. Tip number 6 is called debt consolidation. So what this is you go see either a bank or financial institution and you tell them, I have this credit card here, I have this car loan here, I have this line of credit here, and what they will do is they will take these 3 debt instruments and they will package them in one loan that you could pay down all at the same time. And usually what happens is that this one loan has an overall lower interest rate than the 3 different instruments separately. So if your credit card is 20%, your line of credit is 7%, and your home and your car loan is say 12%, which let's say it came up to an average of, 14% overall, depending on how much you had in each basket. If you consolidate that loan with the loan consolidator, maybe your interest rate will go from 14% to 12%, which means that you'll actually have that savings of 2%, and this will allow you to pay down the debts faster. However, it's important that if you're saving, say, $40 a month, by consolidating your debt, don't go and spend this $40 on something else. Really try to focus and pay down this debt as soon as possible. Now, depending on your situation in life, if you actually own your home and you have equity in the home, you can refinance your mortgage, or you can refinance your home, which means you will be able to pull up to 80% of the value of your home out of your home if it's paid off, for example, or if it's half paid off, then you'll be able to pull out, say, 40% of the value of your home, and you'll be able to use this money to pay off other debts. And the purpose of this, the only purpose of this, should be to pay off higher interest debt. So if your home equity line of credit has an interest rate of 5% and your credit card has an interest rate of 20%, yes, it makes sense to pull money out of your home to pay off that credit card debt because of that higher interest rate. And once you pay off that credit card debt, go ahead and pay off that home equity line of credit, because you don't want to keep this loan outstanding as well, because it's still debt and it's still 5%. And we're talking about how to pay down debt. The point isn't to just take debt, pay down other debt, and make this debt bigger because the interest rate is cheaper and you could afford it. So really, once again, you have to focus on trying to find ways to funnel as much money as possible to pay down your debts. And now tip number 7 is an interesting one, because there are 2 different strategies that people use when it comes to paying down debt. The first one, which is more, I would say, psychologically pleasing, is to pay down the smaller debts first. So if you have a $500 line of credit, let's pay that off first. If you have a $10,000 credit card balance, well, we can pay that off in second. And if you have a $14,000 car loan, we can pay that off in third. So what I mean is, you still need to make the minimum payments on all the debts. But if you have an extra $100 a month, you could funnel that to your smallest debt balance first so that you pay that off faster. And what happens is that if you see that you're actually able to pay off a whole basket of debt on your own, then you're going to be more encouraged to go and tackle the next largest debt. So that's what I mean when I say it's more psychologically pleasing. However, the downside to this is the small debt may have the lowest interest rate, and then the big debt may have the highest interest rate. So what happens is that you will end up spending more money overall once you're done paying down all your debt, since you started with not the highest interest debt, but the lowest interest debt. The second way to actually do this is, like I said earlier, pay off the highest interest debt, because high interest debt is very expensive. If you have debt at 5% and debt at 20%, the debt at 20% will grow and accumulate much faster than the debt at 5%. And this debt costs you more money as well, because the interest rate is higher, very simply put. So the smartest thing to do is to actually pay off the highest interest debt first. But if it is a large balance to pay off, it might be demoralizing because it'll take a while to actually make a dent in it. But it does remain the smartest way. Now, tip number 8 or 9, I'm not too sure, are called balance transfers. So what happens is if you have a $7,000 outstanding balance on your credit card at, say, a 20% interest rate, you can actually move this balance to a new credit card that can offer a promotional interest rate of, say, 2% or 0% for the first 6 months. So for the first 6 months, you won't be paying a penny in interest, or much less interest if it's 2% or 5%, for example, compared to your original 20%. And this can really enable you to get a head start in paying down your debt, because all that money that you won't be paying towards the interest, you can actually use to pay the balance of debt directly. And once this trial period ends out of this balance transfer, you can then look for another credit card that offers a balance transfer, or if that 6-month period was long enough for you to get out of debt, then congratulations, you no longer have any more credit card debt. Well guys, thanks for tuning in. I hope you learned something as usual. Just a couple tips on how to pay off your debt as quickly as possible. And I know that it may seem hard, I know that the mountain may seem very tall, but it is possible. All it takes is a bit of dedication, a bit of learning, and actually getting it done. If you enjoy the content that I'm creating, feel free to subscribe and like the video. It really helps out and encourages me. And I will see you in the next one.